I'm just going to speak to you a little bit this afternoon about some of our views in terms of some of the social financing mechanisms that we've actually been working on and developing, including some of the views on how impact bonds might be further enhanced, but in particular exploring some other mechanisms in the social finance scene. You know, what is actually happening beyond this purely the bond sort of markets, etc. I want to speak about initially some of the demand for social finance and why we're seeing significant opportunities in that space. And as everybody sort of says, you've got to turn your phone off, and the only person that has them is me, which is wonderful. Also, this where this demand for social finance is coming from and why it sort of seems to be so important, and also then this and what's happening in some of the supply sort of markets. Firstly, though. For those of you that don't know, community sector banking has now been in operation for 10 years. It's a joint venture between a company that was originally designed called Community 21, which is owned by non-for-profit organisations, like a mini microcosm of the sector, if you like, and then Bendigo and Adelaide Bank. If you like, the idea of enhancing the capacity, the capability of the sector, how do we maximise capital into the sector was a really important feature of this. How we build the knowledge and the understanding of the issues that are confronting the sector together with the capacity to build financial solutions for the sector was really an integral part of that strategy. I think we heard Jocelyn sort of say before, when they started sort of in Bangkok to actually try and sort of describe for the bankers what was actually happening in the not-for-profit sector, it was really sort of, it's a different language, it's a different thing that you have to go through. Understanding from the not-for-profit sector what is securitisation, what is leverage, how all of these things actually come together is a really other important piece of the pie. So building the knowledge and the understanding of the issues that are confronting the sector together with the financial engineering capabilities and building a vehicle that was specifically designed to actually provide these solutions was really an important process that both the sector partners that we had and the Bendigo and Adelaide Bank went through. From a Bendigo perspective, you can actually understand if the underlying strategy is about building robust economies and communities, you have to build the social infrastructure within those communities. So actually finding mechanisms that actually manage capital around that are really important. I do want to just touch on the role then of CDFIs in this particular space. You may have, there's been some talk earlier today about intermediaries and their role. CDFIs, community development finance institutions, are emerging internationally as a significant part of this social finance agenda because they play that facilitator sort of role. They play the role of understanding the issues that confront the sector together with the issues of the investor markets and how to actually put those together. Similarly, organisations like social ventures, social finance, foresters, for example. So we are seeing emergence of these types of organisations, which Community Sector Bank considers itself one. Earlier today we heard Ben Rimmer from saying that the government is actually not the one that is actually going to manage and develop these types of new products and strategies. It's happy to support and facilitate where it sees some economic and social benefit, but at the same time it needs these intermediaries, the sector, to come along this particular journey, so to speak. Now, this demand for capital it's a really interesting issue because I don't think it just rests with the sector itself. Social finance is actually a matter that actually covers government, private individuals and sector because, and I'll describe the importance of it, but clearly if we are going to build social impact, maximising, you have to deal with the community sector. The community sector is 600,000 organisations in the community sector in Australia. For those of you, I know there's quite a mixed audience here today. 60,000 of those are economically, what we call economically sustainable, and they employ about 1 million people. They're the managers of the social infrastructure, the managers of those assets, the deliverers of that change is actually underpinned by the capacity and the capability of those organisations. So how we work with those organisations and actually elevate their capacity and capability to take investment, to be investment ready, to actually move in this commercial space is an important piece of the equation. However, the sector is not one homogenous group. Don't believe it. In fact, they compete readily. There are some subsectors that actively are more. I'll say they are more aligned to receive investments than other parts of the sector. They do that because some parts of the sector have great asset backing and great certainty on cash flows, like the aged care, childcare, housing organisations in particular, lend themselves to actually more investment type based solutions and strategies. I touched on before why we would want to do this, but if you like, here's the government situation. The talk earlier, no funds available. Got to return the budget to surplus. Major austerity moves across the countries everywhere. So it seems from a demand sort of point of view that we need to find mechanisms that stimulate investment into this market. So it's in the government's interest that we actually find pathways that will actually stimulate investment to maximise the social impact as they're trying to balance budgets in the same sense. Similarly, communities have a similar sort of strategy. I mean, Bendigo's community bank model was one where it actually captures the activity of banking and then reinvests the profits back into build local economies. So communities at large have a role to play in terms of how they're going to support the kind of social agenda issues that they're confronting. Similarly, business, from small business. The value of a small business is actually directly related to the economy in which it actually supports. If that economy has affordable housing issues or justice issues, etc., those things have a direct relationship to the economy at large, the local GDP. So how do I invest as a small businessman in the development of my social infrastructure and development of the issues that are confronting my community? For mining companies that are actually sitting there with major remote communities and fly in, fly out sort of issues, how do they invest in the development of their local economy to actually, which is quite strategic. It's a social investment in one hand, but it's also a strategic investment because it's actually going to minimise and reduce costs. How do medical insurers invest in reduced diabetes in kids? Because for the longevity of that insurance, what's the risk that they're going to have? The risk is an unhealthier society, etc. So if they invest now, they're going to decrease their costs into the future. So what are the pathways that we actually need to build to address that issue? Also, there is a question here for government is about use and application of funds. And sometimes it's not necessarily a new capital that's required. It's how are we currently spending the existing capital? How can we structure that expenditure which maximises the co-contribution into the market? How do we structure it to manage risk and yield so we can actually stimulate those investments overall? The supply of finance, again, this is what's exciting about today. You know, we've had a social impact bond really launched in the UK, and there's some further sort of stuff happening. New facilities are just on their way, but what have we got? A room of people that are just stimulating the discussion and the debate about what other forms of financing and what structures are going to be needed to actually address the issues, and a collaboration in actually achieving that result. But it's clear that impact-based investing is really emerging as a critical component of our society. I was at a function with the CEO of Global Impact Investor Network, Luther Reagan Jr., just last week or the week before. That network, which is made up of institutional investors, insurance companies and the like out of the UK, has invested $56 billion in impact-based investments since 2009. So it is a significant move internationally in terms of what is actually happening in these markets. We have new structures that are actually the Global Alliance of Banking on Values is emerging, headed by Triodos Bank. We also have the International Association of Investors in the Social Economy. So globally, we're seeing great movement in the social finance space, which actually means there's greater mechanisms and structures going to be available to do that. So we're seeing also in Australia the development of super funds. They are having allocations. Christian Super has made a great contribution, but there are sub-funds and sub-allocations made in sustainability, etc. The federal government's CDIF program, which we invested in CIFA, the social ventures as part of that particular program, microcredit programs that have actually been launched by DEWA, the CDFI pilot program, the National Rent Affordability Scheme. So the supply of finance is actually starting to emerge, right? So while community sector banking, for example, has facilitated over $200 million worth of debt funding, you can see that there is a greater interest across banks across the world, across Australia in this particular space. But it's important to develop investment products such as social impact bonds, but equally other products are emerging in the market, such as housing bonds as well. I'll just talk to that just briefly. So we have, in effect, significant demand and significant supply strategies. However, linking that demand and that supply is still a matter of continued debate and structures and strategies of how that's going to be achieved. It's not for us about just building a new fund, and it's probably more about what is the nature of the product and what is the nature of the asset and how the cash flows work and things like. So what's the product? What's the investment product structure actually looks like, and how do we actually make that work? So these products, are actually being supported in other countries as well by certain activities that those countries are undertaking in stimulating investment. We have in the UK, for example, the tax effective structures for investment. We have the Financial Inclusion Growth Fund. We've seen Big Society Capital and the emergence of CDFIs in those particular markets. Big Society Capital, £400 million startup. They intend to grow to about £1 billion, using as a leverage to encourage investment and leveraging and investing directly into social enterprises and CDFI sort of markets. In the US, we have the Community Reinvestment Act. It's a levy placed on mainstream financial institutions to invest or see that investment is incurring in community development. The CDFI fund awarded in the US awarded $1.4 billion to community development organisations and financial institutions as an investment sort of process. Tax credits to private sector investors attract $33 billion in these markets. So we're seeing that the market is actually has got a number of tools that are designed because the governments see this demand sort of issue and supply issue as really important. How do we stimulate investment? And even the government here at the moment is actually discussing what role do they play and what's it look like. So some of the, as I mentioned earlier, there's certain sub-sectors that actually perhaps better avail themselves than others to lending products and debt products. One of the key components is the housing market. The social housing bond market, for example, has been quite a significant push in the UK. Recently we're seeing AAA rated bonds issues and community housing organisations themselves issuing $650 million bond products. The smallest issue that's been lastly done was a small organisation, and a small organisation there had 5,000 houses under management. So that's a small organisation over there. But it managed to get away a $100 million bond issue. AA rated issue. The bond market is quite different over there. But at the same time, the kinds of principles between the community housing organisations over there and us are not necessarily that different, and perhaps in aggregation we can actually build something. Interesting over there, the leverage that they get out of that, in other words, with the asset backing that they have, what amount of funding can we actually produce in accordance with the asset backing? In Australia, we do a lot of debt funding to community housing organisations. The leverage we get is around about 25%. In the UK, they're getting up to 75%. So with the same asset backing, because this is a matter of income streams and how they're enhancing income streams, they're actually achieving nearly 2 to 3 times more capital into the sector, more affordable housing as a result of how we actually structure the facility. And that is a rateable investment product. So we're actually seeing investors trying to attract greater normality in the market, so to speak. Other markets such as aged care, healthcare, Ian just talked about childcare before, seem to actually provide a mechanism where we can actually see new investment type products, new investment mechanisms coming into the market to do that. In effect, they're impact-based investment strategies, they're bond-based quasi-equity sort of structures or debt structures, but they're actually being enhanced or de-risked in some way. And that's an important feature, I think, of what kind of areas that we continue to need to grow and develop our business. NRAS has been mainly a retail-based strategy. It's sort of very much attracting a lot of retail investors in NRAS. But we're also seeing new forms of capital in this market. There is a product called HomeSafe, which is an equity release product for people with ageing people that have ownership of their assets, that are looking for in-home care, or they've got young kids with disabilities but have got not the financial capacity but have an asset, and this equity release type strategy actually allows us to liquidate that asset. And in Australia we have, you know, one of the highest levels of home ownership at that age. So when you retire, there's a lot of people generally own their own home, but how do we, so it's an illiquid asset. So this product was actually designed to actually create liquidity in a market that actually enable people to access that capital, and then if we direct that capital to in-home care or disability services or transitioning people, I think yet again another form of capital that has been structured to deliver this. There is an emergence of a new area called crowdfunding. And a lot of us will sort of say, well, what the heck is that about? And I don't understand it. And it's only small, but I tell you, it's an emerging piece, because what we're seeing is a need to create pathways for people that say, I want to make a difference. And whether or not that is a philanthropic support or a loan support or some form of grant or structure, they want to see the direct outcome. And this is a social media sort of platforms where in aggregation we're actually able to capture that capital and provide support for everything from people that just want a wheelchair to actually real social enterprise activities and outcomes. There's some interesting pieces in that space. So the other, finally, I suppose I just wanted to talk about then, if we've got this supply and we've got demand and there's certain mechanisms like bond sort of structures and other debts, and it's for us about how therefore we blend capital solutions or different forms of capital. And I think the guys at Westpac and Commonwealth Bank were doing, you know, sort of similar things. These tranches that we talk about are actually about how do we blend capital solutions to actually normalise, if you like, the risk and yield. I mean, the big trick here is if you actually can get $100 million, $200, $300 million worth of investments in social impact, and to do that, how do we actually structure the products and frameworks so we're going to normalise, if you like, the risk and yield in terms of some of those investors, and what does it look like? So in a way, what I'm saying is, how do we structure those different kinds of forms of capital? Those different forms have different risk appetites and different yield requirements, and why they would invest in that. And so an investor that says, well, I'm invested for impact, like that graph that was going, I'm going to donate to, I'm going to actually, I want an equity position. If you look at the breadth of types of financial instruments, etc. Now, if they can turn around and say, well, wait a second, if I need to manage liquidity to get an issue away, what form of capital can they go? We've seen Bensock say, I'm underwriting an element of risk in this particular structure. We're seeing in this the sector reinvesting in itself. Why can it do that? Because it knows and understands the risk differently. We're seeing philanthropy saying, wait a tick, if we, instead of just giving a grant, then if we're actually saying, I want to take a position on this particular loan, I'm happy to leverage my funds because I'm actually taking a different view on the risk, then potentially in combination, in a blended solution, we can actually build a better outcome or maximise the investment that actually comes into the market. I think where we found is that the Peter Butter Social Impact Bond product, great start. Where we are today, even better. The products and structures that have been designed and developed actually again are starting to stimulate, but we're also seeing other markets or subsectors that actually better lend themselves to funding structures and debt and notes and bond frameworks that actually will support that. Just lastly, I just wanted to say that, you know, we've been in this space for, I suppose, 10 years. We're dedicated to, that's all we do, and we reinvest our profits sort of back into this business, back into creating new solutions, but you really can't do it yourself. I really love the feeling around the room about collaboration, about sort of lending each other's experience and understanding about this is how we can actually put this together. Because even if, you know, one of the things that comes back, we write a lot of policy for Bendigo Bank in terms of the social finance space. But, you know, some of the first questions that came out of that is, well, why aren't the majors engaged in this? This was some time ago. Why aren't they doing this? Why are we, what's going on here? So you have to actually build the market. In building the market, you actually create a much better environment for us to actually achieve our objectives and goals. So we would really, really welcome that opportunity to get together and talk and consider how we support not-for-profits and the finance markets to actually create some solutions. Thank you very much.